Hey, what's up, everyone, and welcome back for Thursday, March 6th. So we got another red day in the market. The S&P was down almost 2 points. The Dow was down a point. NASDAQ Composite was down about 2.6%, and New York Stock Exchange was down 1.26%. So another red day. That seems to be the theme since we decided to jump in and do this little experiment here, but that's okay. Let's take a look and see the top performing strategies for this week. Looks like it's Trainer's Measure across the board right now. We talked a little bit about Trainer's Measure yesterday and how it's a good measure to use when you're expecting to experience volatility because it identifies and helps to identify stocks that do well during those times. So you can take a look here, and it looks like about 15 years of history, 10 years of history. So longer term history, but it is interesting that you can see now even 10, 20, and 30 stocks are in the top performing portfolios. So really just anything that tends to do well during times of volatility has been doing well so far this week. In terms of the highest volume, we have AGM Group Holdings on top there, plus Therapeutics, and then NVIDIA, and some of the other usual suspects coming in down here below. In terms of some of the biggest gains, you have Plus Therapeutics, you have AMG Group Holdings, which we just mentioned from a volume standpoint, as well. You had Visionary Holdings with a 37% gain, and iHeartMedia with 22.5%, as well. Lending Tree in there, 22.5%. So good day if you owned any of those folks. On the inverse of that, you got the biggest losses over here. You had Leslie's down almost 90%. I believe that's the pool supply company. Clarion down another 77%. Sleep Number Corporation down 42%. So not a great day if you were a shareholder of any of those corporations. Let's take a look at our portfolio and see how that performed. So another red day for the portfolio. Hooray. But let's see how we did. We lost 2.62%. Now that was primarily driven by Tesla. So, negative result for the day. Separating ourselves a little bit more from the index, not a good thing. I have been starting to think a little bit more about trying to determine if there's some other or better options for the portfolio. I think maybe Friday we'll take a look at some comparisons, and we'll come up with a few different views where we can take a look to see if there might be a better fit, including more stocks or diversifying a little bit more, or even just kind of moving away from some of these. But we'll see. I don't have ants in my pants. I'm not really ready to kind of move on from any of them yet. You'll notice as you monitor along and you follow some of these strategies, on average, I'd say I trade anywhere between every 2 weeks and every 8 weeks. And for the most part, that's what the data shows. Last year, about every quarter tended to perform a little bit better. But for the most part, that's when I really start to consider making changes with my own portfolio, is really after about the first 2 weeks. And a lot of times what I have seen is usually, if the market is doing well, you tend to see those gains over the short term kind of peak in that 2 to 8 week window, where if you wanted to cash out and kind of move on to some different assets, that tends to be a good time to do it. It's going to vary depending on everybody's portfolio, but that's just what I've seen personally as I've gone about using these methods. And it seems to work pretty well because a lot of the times when I've held on to stocks longer than that, they start to lose some of their gains and kind of come back down to their averages. So just something to think about as you go about stock selection is really expected return of these assets. And say you're taking a look at a stock and it says it has an 8% annual return. So if you think about it and you're in February or March and you've already earned a 12% return with that stock, you need to think about, just as a frame of reference, have you already earned that return for the year, and is it better to actually move on at that point? And it always varies and it's different, and sometimes it has been a good time to move on, and other times you've wanted to continue to hold. Like historically, Tesla, Palantir, the last few years they've done pretty well, even when analysts and others have been very negative about it. So just something to think about is, what is the expected return for the stock that you're looking at, and is that something that you've already surpassed for the year? And if it is, then I'm not saying sell. I'm just saying take that into consideration into that formula in terms of, hey, do you want to move into different assets or think about things of that nature? So one of the things that I wanted to talk about, I've picked a subject every day where I try to jump into something else and just kind of highlight an area of investment. So today, what I wanted to highlight was the difference between growth and dividend stocks. So I'm going to pull up a graphic here. I'll put it up on the screen. So, I just wanted to emphasize that if you're new to investing and you're looking for investments, you'll hear these two terms, growth stocks and dividend stocks. And essentially what you're looking at is with a growth stock, you're going to have an organization that is looking to provide shareholders a return based on the value of the company. So as that stock price grows, that's how you're earning your return. Versus a dividend stock where they pay their shareholders a return, and then their goal is really to grow the company in order to maximize that return. So it's a little bit different. If you're playing the long game and you're big on like what I have here in the portfolio, Tesla, Palantir, maybe you're comfortable with having growth stocks. But if you're looking into organizations like say oil drilling company, or like here I have Arcadium Lithium mineral supplies. So organizations like that, especially well-established ones, tend to pay out a dividend, and it's a nice way to earn a return. A lot of folks will coach online that you should only use dividend stocks, and there are some good reasons behind that. A lot of times they're more well-established companies. They're able to produce a consistent return over a long time period, which is why a lot of investors have moved to owning shares of that corporation. So certainly there's some advantages from that standpoint. Now, there's no guarantees that they're going to continue to be successful. They have to have good people and good processes in place in order to ensure that that's occurring. But nevertheless, a lot of times the companies that are out there paying dividends are generally more well-established firms. However, there's some big tech companies that are out there that have never paid a dividend, and I know there's a lot of people that have made a lot of money off of them, whether it was Microsoft in the 90s or Google and Facebook in the late 2000s and 2010s. There's a lot of opportunities still for growth stocks. So, but you'll run into folks that try to direct you just solely to dividend stocks, and there are some good reasons for that. But don't let that really limit you from what you put in your portfolio. It's okay to have a little bit of both. Me personally, historically, I've tended to side more on the dividend side, and usually I'd say anywhere from 60 to 80% of my portfolio is generally dividend paying stocks. And just another way to think about dividends is you really want to quantify it in terms of dividend yield. So if you see a company that's paying out a dividend, maybe they pay it annually, maybe it's quarterly, maybe it's twice a year. You also want to understand if they're paying out special dividends, because those can be one-time events. And then from there, what you really need to understand is the dividend yield, which another way to think about it is for every $100 that you're putting into that company, how many dollars are they giving you back through that dividend? Say if they have a 4% dividend yield and you have $1,000 in that company, you're going to get a $40 annual dividend. And a lot of folks, especially as they get closer to retirement, really prefer dividend paying stocks because they can hold on to the cash. Now, with your dividends, you can either choose to reinvest them back and they'll purchase more shares of the stock, or you can just take that distribution in cash. So it really depends on where you're at throughout your life and what your needs are. If you're a person in retirement and you need cash, that's a way to get cash out of your investments, is purchase dividend paying stocks and take the dividend as cash. That way you're never spending your principal. But if you're a younger person and you don't necessarily need the extra cash or you need those dividends, you can always think about doing that reinvestment, and that can really help to make your portfolio grow a lot faster. Every professional and successful person that I've known throughout my life that's been a good investor has always reinvested their dividends, even a lot of times in retirement. So just personal preference, whatever you prefer. For me, I think this was just kind of the topic I wanted to highlight today, was just be aware that there are growth and dividend stocks that are out there. And then when you see dividend stocks, just be cognizant of what is the dividend yield for this asset. And if I'm going to go this route, is that really the best option for me? Because I don't know the exact number right now, but typically out of the 7,000 or so assets that are out there in the New York Stock Exchange and the NASDAQ, about 900 to 1,100 of them at any given time are typically paying a dividend. Now, as the economy goes, then a lot of times so do the dividends. But there are a lot of options that are out there, not even necessarily some of the more traditional ones that you're thinking of. But again, just be aware of dividend yield and take a look at their earnings per share to make sure that it's positive, because you don't want to go and invest in a company that's not earning income themselves, because eventually they're going to get to a point where they can't make that dividend payment. So there you go. All right. Well, stay tuned. Come back tomorrow. We're going to take a look at a comparison. We'll compare one or two stocks to see how they fit into our portfolio, and then we'll take some considerations and have some discussion about, what is that doing to the portfolio and the weights, and whether or not that's something that we want to consider. So stay tuned. I'll see you all tomorrow. Have a great night.